The S&P Global Economics reports today that many market participants expect volatility to define the debt market in 2022 as operating conditions change in the first quarter, no thanks to the Russian war in Ukraine. Now, the S&P Global update says global corporate defaults reached 14 in the first quarter, and that's the highest since the April to June 2021. The S&P further stated that the majority of U.S. buy-side, sell-side, and advisory professionals expect volatility to continue for the foreseeable future, as 35% of investors believe the worst is yet to come regarding price swings in leveraged credit markets. Joining me now to discuss the new risks that emerging and frontier markets face and how to navigate them is Gbite Oduneye. He is the Chief Executive Officer at EG Markets. Gbite is an international investment professional and strategist. He's speaking with me tonight from the city of London. A good evening to you, sir, and thanks for coming through on the show.
It's a pleasure to join you, boss. So thank you very much for having me.
How nervous, Gbite, are international investors right now looking at the global geopolitics, in particular the Russian war in Ukraine and a bit of all those brickbats between Taiwan, Hong Kong, and Russia on the other hand?
It's very worrying, very worrying. Let's not forget, this is all off the backdrop of COVID, where we had massive disruptions in supply chains, really massive disruptions in economic growth. We're predicted that the war is going to move up inflation, which is already at highs not seen since 1982. We believe the war will move inflation by a further 2.5%. And we already think it's going to be shaving off 1% from general economic growth. So the uncertainty is, it's like something we haven't seen in a while. And the issue with it is, we're not able to plan. A number of economies are not able to plan because we're reacting to headlines as they come out of Russia. We're reacting. A week ago, we thought, President Zelensky made it very clear that he will not be joining NATO, and we honestly thought that would be one of the things that will clamp down or reduce the aggression that Russia has shown. But again, as you mentioned today, as you mentioned in your cast earlier on, just news of mass graves being revealed in different parts of Ukraine could again, whatever negotiations that are happening, could change things considerably. So at the moment, until we see some sort of resolution from Ukraine and Russia, it's going to be very, very hard to really predict how global economies will respond. There's so much geopolitical uncertainty, and of course, this is compounded by the fact that we're coming up, broken supply chains as a result of COVID. So investors are very, very nervous. Treasury yield aversion. We can see it play out in capital markets. The uncertainty is there. So yes, there's certain guesses which people could make based on what has gone on from different conflicts in the past. But this is like one we haven't seen in recent time. It's on the European continent. There's a possibility of nuclear weapons being used or being threatened. So the level of uncertainty is like something we have not seen since World War II, to be honest. So to say how the world economy goes without us having some sort of not certainty, but some sort of feeling as to if the war is going to be a prolonged war or if they're going to soon, get to the negotiating table, it really depends on that, boss. So the uncertainty is really high. Investors are, running away from risky assets, and they're going to places where they can get reduce their risk considerably.
Interesting how things are beginning to play out. What are investors really worried when we talk about the Russia-Ukraine war? Are they worried that this could go much longer than expected, or that Moscow would come under further sanctions and whatever hits Moscow, one way or the other, the rest of the global markets are going to catch some cold from that? If you can't lock Russia out, it's quite huge in terms of the market. Yes.
At the moment, boss, if you think about it, inflation is going to accelerate here in Europe because Russia supplies a massive amount of oil and gas to Europe. It's not something they could just stop. Even if they're going to reduce it, as Germany and France has mentioned, it's going to take a considerable amount of time. There have been a number of things that have happened in Britain and France with their energy prices going up considerably. So my point is, the case of an all-out war is just unthinkable, because if we do get to the case of an all-out war, all this analysis that we're having now is pretty irrelevant, because we're going to go into seeing things that we've not seen in modern history. But the reality is, Russia does still, Europe is still buying a considerable amount of oil and gas from Russia. If they were to reduce that, and the reasons why they haven't reduced it, not been able to reduce it considerably, is because it's going to affect their bottom line. Inflation will go through the roof within European economies. Their economies are intertwined. So it's going to be very, very difficult. Hence why, Russia could continuously threaten a number of things, because they know that it's going to be very difficult for Europe in the short to medium term to wean their economies off Russian oil and gas. So as a result of that, they maintain a very strong position in negotiating. So I think where we will begin to see some sort of certainty is if we get to, President Zelensky has made it clear that he's no longer going to join NATO, which is one of the important things for Russia. I think if we're able to get to a situation where negotiation starts, even if there's no certainty that the war will be over, but if we're able to get to a position where the violence reduces and negotiation starts to a certain point, then we will start to see a certain level of confidence grow in global economies. And the other thing which we anticipated, what we thought would happen, is after a while, the war fatigue, the fact that it's been reported that after a while economies will move on. But this is so much intertwined into the European economy that it's really difficult to see any way in which we will move on without getting some sort of certainty. And then the fact that Russia is a nuclear power, again, the response from the United States and NATO is going to be difficult for them just to talk them away. So it looks as if we might be in for a prolonged uncertainty. Now, whether this goes on for another quarter, it's one of those ones that everybody's looking at really from day to day, or from headline to headline.
As we've got so much war and problems and misery and refugees and folks in the hundreds of thousands and millions suffering from the Russian aggression in Ukraine, on one hand, that's just those politics. But is this some sort of good news for those of you on Market Street, when the UK says it wants to position the country as the crypto capital of the world, while there are complaints that there are tight regulations from those who are interested in the crypto business? What are your thoughts?
Well, the crypto business has been one that has been it's been extremely interesting. You go across the board, you would have almost every government wants to ban it. No one seems to say anything positive about it. It almost seems as if over the last couple of years that almost every government, from the United States to Britain, India, China, they have tried to scare everyone from using it. Now, the more we look at it, it does look as if everybody is preparing to want to, be the global hub for cryptocurrency. China would love to. Britain, of course, they would love to. So would America. So it now seems that finally, after a couple of years of talking cryptocurrencies down, central banks across the globe have understood, or they've realized that it's here to stay. So a number of people are making, first mover advantage, should I say. And of course, Britain being one of the financial hubs of the world, they've thrown their hats into this. I know the Treasury, for example, have launched an NFT mint. They have released, I think yesterday, some regulations on stable coins. So clearly they have dropped the gauntlet in that they plan to be open for business in cryptocurrency. So they've pretty much made the first move, and they've invited a number of exchanges and a number of people to come in and pretty much build the regulation. But they have taken the first shot, and it's not something. Although we did hear all the negative stuff coming out of the Treasury over the last couple of years, we were certain that a number of jurisdictions were positioning to try and take advantage and be the cryptocurrency hub of the world. There are going to be a number of countries that will come out now that Britain has. It's going to be a competition on who provides the most suitable terms and the most comfort and convenience for trading. But of course, Britain has come out and made it very clear that they would like to be a jurisdiction where cryptocurrencies grows and flourishes.
And that, yes, crypto's business is still moving on very well. But aside crypto, what are the most favorite global investable assets at the moment with you have the trading engine? Tell me.
Well, so I mean, at the moment, on the majority of things, everybody's avoiding risk assets. You know, it was a very horrible start to the beginning of the year where the markets collapsed considerably. But we did, and that was really in the beginning down to, if you remember, the Federal Reserve wanting to reduce interest rates. One, because of course we saw problems with inflation, and also they thought that the US economy was growing a bit faster. So it made sense at the time to reduce interest rates. Now, since then, Russia has attacked Ukraine. Now, that is something that nobody anticipated, nobody expected. And now, like I said, under normal circumstances, when there's so much risk out there, what normally happens is all the money goes into treasury bonds, low risk. Treasury bonds has been where a lot of money has gone. Now, what sort of return are you going to get? Very, very little. But in the current economic state, what you're looking for is security. Now, saying that, and this is, although I would say it's a big if, this is not the first time we have seen these sorts of difficulties in global economies. I mean, a good example would be March 2022, when the world shut down as a result of COVID, and markets collapsed by about 40% in the course of 3 to 4 weeks. 8 months or a year after that, the markets had regained every single last thing. So yes, at the moment, everybody's tolerance for risk is completely diminished as a result of the massive geopolitical uncertainty, as well as even monetary policy right now. The world has been through a lot, considering we're coming off COVID. But if we get the right sort of body language and body posturing from Ukraine and Russia, we are expecting there to be a very, very quick rebound in a number of these assets. So at the moment, everybody is playing it safe. I mean, it's the less risky assets where most of the money is going into. I mean, from what I've got, I'm down here before I came onto the show, Bosun. It's all the treasury bonds. Treasury bonds. That's where all the money is going into. But like I said again, as they like to say, the hawks are circling and they are waiting, anticipating what the headlines are going to see or what the mood is going to be from Russia and Ukraine, because projections going forward could change just like that. But at the moment, everybody is, a number of people are playing it safe, reducing their exposure to risk.
So as we begin to wrap up this conversation about these risks that markets do face, so frontier markets such as Nigeria, South Africa, Kenya, Ghana, are they far removed from the booming guns of the Russians and the Ukrainians? Are they far removed from China and the rest? Are we insulated, as it were? Put all of this together and give me what your outlook is. What's your playbook for emerging and frontier markets?
Well, again, prior to the war, we were a bit excited because we thought the emerging and frontier markets would do better and then developed markets coming out of COVID. We honestly thought they were better placed. The effect of COVID on their economies, in as much as it was difficult, we did think that they would come out strong. Now, with the war in Ukraine, obviously a number of supply chains hadn't completely recovered prior to the war happening, and inflation moving at the way it is moving. You then couple that, Bosun, with the fact that we've seen considerable drops in risky assets in the developing world. There is a fear that a lot of the investments that would normally flow to emerging and frontier markets might find homes in developed in developed markets, considering that there has been a massive discount as a result in the global uncertainty that has happened. But saying that, we are bullish. We are still bullish, although the inflation does worry us. And a number of the large economies, Nigeria, for example, with an election looming next year, and inflation not particularly where we would like it to be, and as well as us not benefiting from the massive rise in oil prices, we are not as bullish as we were prior to the war on Ukraine. We will continue to monitor the situation. We do think it does have the possibility to grow, but as a result of the war in Ukraine and the damage to developed markets, there's just that fear that a lot of the capital that would have found its home in frontier and emerging markets would find very decent deals and bargains in the developed world.
Receive perspectives and insights from you. Thank you so much for those insights on the global markets. Bite Oduneye, CEO at EG Markets.